Good afternoon. My name is Nelson Ogunshakin. I know we are still in January. May I take this opportunity to wish you guys, wherever you are, compliment of the season. We're delighted to be joining the final part of the conversation on the merger and acquisition. Today's particular topic is looking at post-merger integration, which is realizing the corporate objective. As in the past, I'm delighted to introduce my colleagues who are joining the particular panel. We had in the past, and as today, three other candidates who is joining me. But before I sort of introduce them, can I just set out the agenda? One is to give the background to the conversation. Second, just to review the item that we've covered so far, which we've looked at the growth strategy, which is buying, that was done on the 18th of November in 2015. It's interesting how quickly time has gone by. We dealt with the issue about selling the business on the 9th of December. That was last year. And today's focus is really now post-merger integration. I believe that this subject will cover three areas, which is really strategic objectives. What does it mean for your company? We'll look at the financial implications at the post-merger integration side, and we also look at the legal section. And really, finally, we come back later on to talk about remarks about how do we move forward. The three candidates who are joining me are Dan Nixon, who is a partner at WK Corporate Finance, and you'll probably hear from him later on. You got James Hutchinson, who is a partner at Beale & Co., and there's Dwight Patton from ACE, who's our Group Legal Director. Before I dive into the topic for today, I think it's worth reflecting. I remember when we started the very first one, we had about 80 delegates who register, and the composition of that delegates cover from graduate to director to CEO. At the last one that we did, which is looking at the sales of your company, we had about 65. And today, I believe we have about 45 people register for this particular webinar. The interesting comment that comes out of that is really the quality of people which cut across from graduate to CEO. And I suspect because today's subject is about post-merger integration, there's more people who are focused on doing it from the legal department, from the insurance department, from CEO point of view. So that's quite interesting, and hopefully we can carry you along as we go through. I thought I should start this afternoon by just giving some of the key drivers for a good and effective merger integration. Looking through a number of examples and recent case studies in the industry, it's quite obvious that one needs to set the agenda very much early in the conversation today. First of all, I think good post-merger integration is about realizing both the financial and the strategic goals. Success is a choice, not a matter of luck. So it's very important that subject is treated as a strategic goals. Transaction completion, you look at, the target, you look at the process, you go through the process. There are a number of things that need to be looked at post completion of the merger and acquisition. We'll be talking about that. That's issue to do with regulatory process, issue to do with agreement and contract, both technical contract, commercial contract needs to be looked at. There is the process about change management, which is managing the transition, and that's very critical to ensure there's a champion within the organization that drive and own the actual agenda. Communication is very critical, whether it's to stakeholders, and that's both internal and also external. And the subject of PMI is very important in how you engage both internal and external communication. I'll talk about that a little bit later on. We talked about synergy when you talk about merger and acquisition, which is the general presumption is 2 + 2 should be 5. Now, you only make 5 if you can create a synergy, and it's very important that that synergy is converted. So again, I will talk a little bit about that later on. Creating the right culture. You have 2 companies or 3 companies evolving. How do they share the vision, the core objective? How do they share value or common norms, which is the way you operate in a business? That's very critical. Then the value proposition, which is delivering the shareholders' value, is also critical. How do you maintain the stakeholders and ensure the objective you set out right at the beginning of the M&A is actually achieved? So I will be talking a little bit about that. Before I go into that, I thought, it's worth saying a few words about it. If you look at a lot of the merger and acquisitions happening, I think it's fair to say the industry is consolidating and growth is imperative. So to actually maintain that growth, PMI is very important. Top performing company in the industry not only look at the M&A but also look at organic. So one needs to be mindful of the two options available as part of the growth strategy. Any good deal have both a strategic and financial rationale. One have to apply both lenses in planning and the execution of post-merger integration. That's very critical. The post-merger integration itself is an opportunity to realize both the financial and the strategic goals. So success is a choice, not a matter of luck. You have to design now. And what I hope we cover this afternoon is an idea of how to achieve that. And finally, really, I just want to close up by saying high growth company will be hard to beat. The gap with the top tier company is very increasing, and one have to be mindful of that. If you look through from 2000 to 2014 across our own sector, the global M&A market has been growing, and it dips in 2008 because we know there was a recession. But the market is in the upward swinging, and that is looking in the right direction. So the evidence is that there will be more deals, and the deal flow is actually coming to the pipeline. When you look at companies' performance and you look at how they are into the top quarter and the second quarter, invariably you do see that both organic and inorganic, which is an M&A, are both applicable in order to be successful in your sector. Looking through the deals that have actually been completed and look at the financial rationale, it's very critical that one needs to emphasize that strengthening a leadership position in a certain market is quite important. Creating access to a new market, that is also another key driver. Strengthening specific expertise in the domain of your expertise is critical. And more importantly, strengthening a certain capability within an organization is equally critical. What I want to go through now over the next 5 minutes is really to go through 10 bullet points of key items that need to be looked at, which is really how do you ensure success in your merger and acquisition. First point that I need to raise is that like any other business, I think having a clear summary of the strategy is very important, which is looking at the governance, the organization structure, the integral, process that you intend to approach is very important. This creates a shared and deep understanding of both businesses. So if two companies are coming together, it's extremely important that at the onset, there is a clear governance structure and an organization structure is well articulated and people are aware of what the end games are. Second point is to do with customers, because part of the whole idea of M&A is you actually branch out and you reach customers. So retaining customer is very critical. We've seen that in our industry recently. We need to be sure in such a way that monitors of the client retention and satisfaction is continuous throughout the whole process. Communicating with client and key stakeholder is extremely important. It may be a case that you may have to select and decide which particular client you want to retain, and then develop the best people in your organization to make sure you achieve that. But it's all equally important in the process of your post-merger integration. I also feel that looking at how do you maximize cost in the synergy is very important for revenue synergy, as well as revising the target continually. The PMI program should allow you to look at where do you have the best opportunity to increase your revenue, or even where you feel you are not making enough margin and where you need to divest the business. So it's very important you set up a separate merger program, a clear program that sets out with a clear phasing of deliverables and short-term listing. Item number 6 I've got on the list, I said, managed merger as a separate program. This is very important. A lot of people go into the M&A process not thinking about the post-merger implication. So you need to manage the process of delivering the integration. And that means that, with a clear project structure, we need mirroring the future organization structure and how you intend to deliver. And more important, setting up a PMO, which is a project management office, is very critical. Now, you could probably say this sounds like a textbook. Believe it or not, whether you're a small company or a medium-sized company or a large-sized company, this is equally imperative. One is not suggesting you use a sledgehammer to crack a nut, but it's very important that an individual is actually assigned and a team is assigned to deliver that post-merger integration. Very, very important. There is tendency for people to assume it's business as usual, but that's not the case. Deploying enough resources for integration is critical. What I find out in my past experience and what I've seen is most cases the HR, the finance, and the marketing people tend to come at the tail end, when in fact they should be involved at the onset. So in your PMO, which is your your project management office, there has to be a critical number of key people in the supporting services that engage in delivery of the PMI. So finance is very important, HR is very important, and equally important is the legal proceeding. Communication is a key part. Define a split communication program, and that is not purely just internally, but also need to be looked at from internal point of view. So the use of instruments and communication about the process when in context is very, very important. I use the phrase that in bringing 2 or 3 companies together, we've seen a number of breakdown in those companies purely because the communication is not properly structured, is not targeted, and is not effective. So finally, is the issue about managing the culture. Bringing 2 companies together and making 2 plus 2 equal 5 is easily said and done. Actually, in most cases, if it's not carefully managed, 2 plus 2 can be 3, in which case you've actually created a value destroyer rather than a value creation. So having the right approach and creating the right culture is very important in the way you go about. So managing the culture and the human side of the business is very, very important in achieving a successful post-merger integration. When you look at high growth companies, most of them are very high, difficult to beat because they manage the gap in a way that not only to look at the outgrowing your own competitors in terms of organic and inorganic growth, but they also look at the high value side of it. Managing more growth is very important, but it's easier said than done. And what I've always suggested to people is when you do get married, make sure you are heading the same direction. Now, the subject of M&A is something that we can spend a whole day to talk about. This particular session is really to give the key message, and I think I reiterate the idea that consolidation will continue and growth is imperative. And it's extremely important that if people wish to venture into merger and acquisition, that post-merger integration is taken seriously. That's very critical. Top performance in the industry combine both organic and inorganic growth. So you need to master both. One cannot do without the other. Good deals have both strategic and financial rationale, and both need to be applied. It's very important that post-merger integration is not taken lightly. It's extremely important that a clear strategy and communication process is put in place. And I just want to conclude that high growth company will be hard to beat. The gap for tier 2 company will only increase. Thank you very much.
Thanks, Nelson. It's Dwight Patton here, Legal Director for ACE. Nelson, thank you very much for going through those key strategic issues on PMI. And I'd just like to drill into a couple of those points, if you don't mind. You said quite a lot there about managing the program of PMI and for example, having a designated PMO, a post-merger office. And I just wondering if you could say a little bit about the timing and the program side of it, and firstly, is there a right and ideal timing to the integration process? And I think as a follow-on to that, Nelson, if you could say something about branding and if there's a right time to look at changing the branding if that's part of what you're doing.
Thanks very much, Dwight. 2 questions there. One is about timing of the post-merger integration. How quickly do you do it? And second one is to do with branding. When do you change brand? I think, on the timing side, there is never any perfect, timing that you can actually recommend. However, some companies see M&A as a key part of their strategic growth, and they have a very good internal process to dealing with it. But at the same time, when you value the company in the process of your due diligence, you understand the sensitivities that goes with the previous company that you are buying. You understand the value that goes with that, and all of that need to come into a program that is agreeable with the management at the point before you even close the deal. Because not agreeing that timing upfront major causation of problem at the PMI stage. So it's very important that there is an agreed time scale between the buying company and the selling company, particularly within the management, to ensure that what you are buying, you don't damage it. If you do it too quickly, you could damage the business. If you drag it for too long, you may probably don't get this synergy that you intend to get. So that's very important. So it's the key word is at the point of consultation within the big management team, there's a clear understanding of the criticality and the sensitivity that goes with that. Because both sides will understand where we're coming from and where you're going. And it's very important that you carry the management together. On the issue about branding, in fact, sometimes the branding is part of the value proposition. In some company, they're pretty good at dropping the old brand and actually, imposing the new brand. Again, there is never any right time or wrong time, but I think it comes down to the sensitivity that goes in. What is it that you are buying? How sensitive is that brand in that market? If you are buying a company outside your normal area and the brand is very critical, a joint badge approach may be an interim measure for a year or two to manage that process, and at a point where you drop it. And there may be time where you actually keep the brand as a stand and actually branded it as a subsidiary of a bigger company. That way, you maintain your customer, you maintain the integrity, and you actually keep that particular market share that you want to. Because in effect, when you buy in a company, you're either growing share or you're acquiring the share. So it's very important the timing that is carefully managed for either the fully integration or to do with change of brand.
Thank you very much. Can I just remind everybody listening that you can send us in your questions, if you have any, for Nelson or the other members of the presentation team today. We'd really welcome those questions. Nelson, I'll just follow on with the theme of managing the PMI process. And this question is really about where there's an international element to your merger. Are there any particular issues that come up or ways in which you manage or deal with integration on a cross-border acquisition?
The question, if I can rephrase that, how sensitive do you manage cross-border acquisition so that you don't damage what you buy? Joy, that's a fantastic question, and it's a question that I think is a really good question because we've seen a lot of cross-border acquisition in our space, particularly over the last 4 or 5 years. Even more important, I've actually seen that in other professional services. The key point I come across in there is one about understanding the cultural differences. When you do your due diligence process, in most cases you focus on the legal, the finance, and the soft side tend to be left beside. In a cross-border situation, there are things that one needs to be looked at. One is the legal side. Are there differences in the legal side, what you can do, what you can't do? But more important is the culture and what is in the air. Let me give you a classic example. If you're an American-based company, you acquire a British-based company, there's some similarities in language, and there are some similarities in culture. But the way things are done in America is slightly different from the way things are done in Britain. So understanding the sensitivity is very critical. If you're American or European-based company and you acquire UK with an Asian-based branch, and your composition of your staff in Asia is Asian, professionals, their cultural orientation is very important. So how do you deal with that? One is about making sure that you create an opportunity to understand the cultural differences. Two, you also create opportunity for leaders in those cultural boundary differences to understand where you're coming from and what ultimately you're trying to achieve. And third one, which is most important, is engaging them in such a way that you give them an opportunity to air the views of things that is acceptable and things that is not acceptable. Because if you don't get those 3 points right, what has been evidenced in the last 3, 4, 5 years is really you have companies where there's a breakout because of cultural differences. And in that breakout, effectively, you see a group or a cluster of people, whether in particular area of expertise or in cultural environment, where they thought they were part of the team, suddenly they become part of a bigger team and they don't see a cultural fit. So the key word is understanding the culture, understanding people's decision-making process, understanding the way to look at leadership, and understanding the way you measure performance. Because if you miss that in the process of cross-border integration, it can be a counterproductive opportunity.
Thanks, Nelson. This question sort of relates to management, or possibly where something maybe didn't go quite right with the management side of PMI. We've seen a trend of a lot of medium and large amalgamations within the sector. And then a second trend of some spin-outs of teams of people from those amalgamations forming their own businesses. And I'm just wondering if you could say anything about why we're tending to see that kind of activity.
The challenge that any company has, especially in buying professional, is recognizing that it is human and intellectual capacity that you are buying. And people in professional services have different drivers. Some people are very comfortable in being a large organization. Some are very, very comfortable in a very collegial, very small, and very tight-knitted organization. The danger that any PMI, program has is recognizing that. And again, it goes back to the issue about having a clear integration program agreed with the acquired company at the beginning, particularly with the management team, and also understanding the differences within one company. So, for example, if you acquire a company in excess of 1,000 and 2,000, and they're spread in different geographical regions, there's a cultural differences there originally, but they also have different discipline and different disciplinary process and procedure and what they do. Again, that's another element of potential area of issues. And in the process of consultation within the organization, if there is not adequate consultation and communication with the various strands, and they don't share the value, the norms, and the culture that is being put together, invariably people will consider, should we stay or should we go? And in most cases, what you tend to find, the leader will sign off, and before you know it, there will be a cluster of people that will join. And that is actually against the whole philosophy of leveraging on M&A. So the answer really is effective communication and make sure you get good buy-in by the senior management. And where there are confusions as to what the ultimate goal is, spend time and resources to make sure you deal with it. Because if you don't deal with it, you may have a business that is cannibalized. And I'm sure the ultimate game is not to do that, but to build on the asset that they actually buy.
It's interesting. A lot of the points you're making about PMI seem to relate to preparing for the actual merger, so sometime in advance. And when do you start doing these consultations and really planning for all these issues like managing talent and that sort of thing?
The answer to that is very, very much at the very early stage. Of course, there are sensitive periods where you cannot talk to a lot of people about the transaction. But once you get to a point where there is a mutual understanding, where there is head of agreement in place, and there are issues going on into the next phase, it's very important that the senior management, which understand the business you're buying, understand the peculiarity in this business, that they're engaged in the program of the transformation, because it's a transformation program. So that transformation program have to be bought in by both sides of it. So they don't see that being forced on them. And the issue about breakout, the issue about companies or intercultural differences can be addressed at that very early stage. But obviously, there is never a perfect solution at the beginning. You have an idea, you work on it, and gradually throughout the whole process, you continue to actually revisit it through a dedicated project manager who is tasked to take that challenge and take it forward. Without that dedicated person, it's always very difficult to drive it forward.
Thanks. I've just got time for one quick one, Nelson, and then we're going to hand over to Dan, which is if you could just comment quickly on how you manage external stakeholders such as clients, suppliers, other stakeholders.
In professional services, if I can just refrain, or actually in other businesses, one of the things that you buy or you expect to converge in merger and acquisition is either a new client, influential, and key people in the industry, particularly, new clients. Also equally important, existing clients. If you are doing vertical integration, in other words, you're coming out of your comfort zone, people are very wary. What is the outcome of this integration? Can it be done? Will it deliver the same services? So communication and engagement with key stakeholder is very important. And I will always recommend that it's very important. The top 10, top 20 clients, you identify them very early on. Both sides of the company sign up to them. You identify who's the key people to talk to and you engage them on a one-on-one basis. It's always good to write, but actually it's quite good to meet face to face and explain the process so that if they have any doubt, that doubt can be demystified very quickly. That's critical. Client in particular is very important. New client acquired as a result of the M&A, again, that's equally important. Where there is potential area of conflict of interest, then that needs to be identified and a special task force needs to be given to that so that that issue can be addressed very quickly and the client in that particular area knows that their business, their contract is not going to be compromised.
Thanks, Nelson. Okay, we're going to hand over to Dan Nixon now, who's going to look at the financial aspects of PMI. Can I just remind all the listeners that we would very much welcome any questions you have or comments, which you can type in on your screen. I'm going to hand over to Dan now.
Thank you, Dwight, and good afternoon, and welcome to everyone here today for this, my presentation on post-merger integration. Firstly, for those new to our webinar series, I'm a partner at top 20 accountancy firm Wilkins Kennedy and Director of Corporate Finance. I'm a qualified ACA accountant, having been working in corporate finance for more than 9 years and have advised on 80 plus completed transactions. My firm, WK Corporate Finance, is a wholly owned subsidiary of WK, and we have multiple locations in London and the South East, and we offer a complete range of corporate finance services in the SME space, advising on transactions typically £2 to £50 million range. Coming on to the post-merger integration talk today, this is really for me going to focus on two key areas. So how to prepare for PMI pre-deal via due diligence, and then how to manage and monitor PMI post-deal. However, before we kind of dive into that, first of all, I just want to cover off what exactly we mean by merger or perhaps acquisition. So if you Google merger, a variety of marginally different but similar definitions come up. But what is commonplace in all of them is the notion that a merger is the combination of two entities into one. This is distinctly different in its definition to an acquisition, whereby this is a takeover of one entity by another. Public perception is such that mergers can be generally regarded as good and acquisitions, or more specifically takeovers, considered bad. The reality is that either can be good or bad. So which is it? Does a transaction have more characteristics aligned to a merger or an acquisition? Are the two businesses' identities being retained, or perhaps one new identity incorporating both is being launched? If so, this feels more aligned to a merger. Are both board of directors being retained to create a new hybrid board, or is one board absorbing another? The reality is that the terms are often interchanged, with true mergers rather uncommon and acquisitions carrying a negative perception. There seems to be a desire to present many acquisitions as mergers, and commercially speaking this doesn't matter too much, and actually, to be fair, it's probably more on the money. And from a marketing perspective, it can be advantages to playing the merger card. Technically speaking, however, there is a distinct difference between the two, and I'll come on to that later in my presentation. So jumping ahead onto the financial due diligence pre-merger as a tool to prepare for PMI. The main focus of due diligence, more often than not pre-deal, is to investigate the financial performance and position of the business in order to help support the valuation and/or aid with deal negotiations. An aspect that can be overlooked during due diligence is planning for what happens after the transaction. I've categorised my points into three main areas, the first being transaction-related items, funding structure and working capital. It is imperative to get under the skin of the other business. This means understanding the cash flows and the forecast assumptions post-transaction. Is the business going to have a suitable level of working capital assets and cash to self-fund for the foreseeable future? What finance facilities are going to be made available to the businesses post-transaction? As ever, it is important to ensure adequate facilities are in place. Something that all of my private equity clients are imperative about when undertaking transactions is to ensure there is more than adequate headroom in any transaction. After all, the last thing you want to happen is for a substantial funding requirement to arise that is unbudgeted and will require financing from one entity to another, or worse still, a call for more external finance. Deal structure, for example, shares or assets. Will there be any reorganisation of the group required? Perhaps a tidy up or hive up of assets and liquidation of old companies. It could be wise to review a number of scenarios pre-deal to ensure the most commercially viable and tax efficient route is taken post-deal. Something we see from time to time is some of the more admin post-completion tasks being unfinished, for example liquidation of dormant subsidiaries. Synergies. A significant part of the due diligence process should be an assessment of the potential synergy gains. These could be in the form of additional sales or reduced costs. For example, where the two merged entities are complementary rather than competitor services and serve a comparable but different client base, there is an immediate opportunity to 1. Cross-sell the other entity's services to your client base, and 2. Cross-sell your services to the other entity's client base. However full of assumptions it might be, some formulaic approach to calculating the potential sales uplift from being part of a bigger group should be undertaken. Similarly, what costs are incurred, which as part of one larger entity could be avoided. Central infrastructure related costs are often the more easily identified items, e.g. rent and rates, where one business moves into the premises of the other. The less obvious avoidable costs can be the ones above the gross profit line, whereby, for example, as a larger entity, better buying power is achieved, or the adoption of best practice leading to efficiency gains. And lastly, incentivizing vendors. It's quite common in transactions for there to be an element of earn-out for vendors. In this situation, chances are this earn-out element will be based on the future success of the business. In my experience, when advising buyers, we would typically try to negotiate an earn-out based on net profit. Conversely, when advising sellers, we would typically try to negotiate an earn-out based on sales. The second aspect I've considered is the reporting requirements. Financial reporting system. During the due diligence process, it's important to assess the financial reporting system, process and procedures. The reason being that following the transaction, a key fundamental to a successful PMI, as touched upon by Nelson earlier, is the alignment of finance. One key system within this is the finance reporting system. During that due diligence process, it may be determined that a complete integration of the two reporting systems is unnecessary and that one can actually feed into the other as part of a monthly periodic routine in the business. The key output here is to have a plan of action. On the year end, another aspect to consider pre-deal. Assuming that the entity being acquired and merged into the existing business is a separate limited company, i.e. a share purchase, then that entity will already prepare year-end accounts. An issue arises when consolidated year-end accounts are prepared if the year-end of the other business is more than 3 months different to the existing business. In this situation, I would advise that the year-end of the business recently acquired is changed and aligned. Whilst Companies House Act only permits one change in year end every 5 years, it does allow the alteration of a company's year end to align itself with its parent to fall outside of this. However, it should be noted when aligning year ends, it is not permitted to extend an accounting period to more than 18 months. Finally, VAT. We often advise clients making acquisitions or mergers to join that business into either an existing VAT group or create a new VAT group. The reason being that if entities are part of the same VAT group, no VAT is accounted on any intercompany transactions. The third aspect is the accounting. And what I mean by this specifically is a result of the structure and essence of the transaction. What is the accounting treatment? And now with the change in accounting standards upon us, it is imperative to be on top of this. A new financial reporting framework for UK unlisted entities came into full force on the beginning of the 1st of Jan 2015. This new succinct set of standards addresses business combinations in a comparable but marginally different way. By definition, a business combination is the bringing together of separate entities or businesses into one reporting entity. Per the definition, the result of nearly all business combinations is that one entity, the acquirer, obtains control of one or more other businesses, the acquiree. The acquisition date is the date on which the acquirer obtains control of the acquiree. The purchase method of accounting is the default way in which all business combinations should be accounted for, except for group reconstructions, which may be accounted for by using the merger accounting method, and public benefit entity combinations. The purchase method involves a few steps. Identifying the acquirer. The acquirer is the combining entity that obtains control of the other combining entities or businesses. In practice, what this means, applying the guidelines, is that in very few circumstances can an acquirer not be identified. Measuring the cost of the combination. The acquirer shall measure the cost of a business combination using fair values and also costs directly attributable to the business combination, and then allocating at the acquisition date the cost of the business combination to the assets acquired and liabilities. So what about merger accounting? As stated, the reality is that in very few circumstances can an acquirer not be identified. However, there are specific instances when this can be used, and that is specifically a group reconstruction, provided the use of the merger accounting method is not prohibited by company law or other relevant legislation. The ultimate equity holders remain the same. No non-controlling interest in the net assets of the group is altered by the transfer. FRS 102 in respect to business combinations, unlike its predecessor, imposes a strict finite life on goodwill. That is now a maximum of 10 years where no other reliable estimate can be found. This is a significant difference, as the old standards did allow for the non-amortization of goodwill. So here I've covered a number of the points that should be addressed as part of the financial due diligence process pre-deal. Now I'll come on to some post-deal aspects. So having prepared for the business merger through the due diligence process, I'm now going to cover a few points. Firstly, transaction-related. Synergies, in practice, I see all too often that the excitement of doing the deal quickly falls away after the transaction. What then happens is that everyone gets back to their day job and the effectiveness and success of the transaction is not necessarily measured and or evaluated. Having established what the anticipated synergies of doing the transaction will be during the due diligence process, it is imperative that these are then assessed on an ongoing basis to understand whether they are being achieved, and if they are not being achieved, why not. In relation to earn-out, having agreed the earn-out mechanism and the period over which the earn-out will cover, it will be a requirement to ensure that in accordance with the SPA, the accounts supporting the earn-out and any related calculations are prepared in a particular way. This may not necessarily be consistent with how the business has historically prepared its financial statements. Therefore, I'd recommend that the management and monitoring of this element of any transaction is action from an early point. And finally, the admin, as I refer to it, it doesn't necessarily specifically mean admin only, but it's a 100-day plan, and I refer to it as admin because it's anything more strategic is likely to have a more medium-term horizon. This is the opportunity to hit the ground running. The 100-day plan is merely a plan of action, you could say checklist, to address items such as any post-completion conditions from the SPA at the early stages of the post-deal period. This 100-day plan can include a whole host of matters. A couple of such are change in the management accounts format to be more consistent with the other businesses, or to investigate some tax benefits which may not have been historically claimed, for example, R&D tax relief. So coming to the end of my presentation on post-merger integration, I think in conclusion what I found interesting as part of this process of preparing for this webinar on PMI was that in doing so, the balance tipped well in favour of what to do before the transaction. And this for me hits the nail on the head. It certainly doesn't devalue the substantial hard work and execution skills required to effect a successful post-merger integration, but it really does emphasise the importance of planning. This now brings me to the end of my presentation. Thank you for listening, and if you have any questions arising, please either contact us via the webinar or follow up using the contact details on the screen.
Dan, thank you very much. That's all extremely useful. We're a little bit behind, but I'm going to hit you with one question, if you don't mind, which is, you touched on the new financial reporting framework for UK unlisted entities, this FRS 102, and you mentioned goodwill as a particular issue, as a major change in terms of treatment. What other aspects of that should we be concerned about when assessing a post-merger?
Thanks, Dwight. This is a question which I probably won't be able to do complete justice in the time. So I will naturally refer people to speak to their accountant to get a complete answer. But just taking a couple of highlights, and this is very topical at the moment because this is a timely matter. It's hitting any year ends commencing on or after the 1st of January 2015, and two particular topics are holiday pay accrual. FRS 102 requires holiday pay to be accounted for, which historically hasn't been required under UK GAAP. Therefore, any holiday pay owed to an employee at the balance sheet date has to be accrued in that balance sheet. The second point is around leases. So historically, leases and rent-free periods. So rent-free periods could be absorbed across the period up to any break clause. Now they will be absorbed across the entire period of the lease. So I think it's probably fair to say that holiday pay accrual could have a negative impact. The lease point could actually could impact negatively as well.
Thank you very much, Dan. I think we're going to now hand over to James Hutchinson of Beale & Co., who's going to look at the legal issues arising on PMI. Over to you, James.
Good afternoon. Thank you very much, Dwight and Dan. I'm James Hutchinson. I'm a partner in the corporate team of Beale & Company. I specialise in acquisitions and sales of predominantly construction-related businesses, so people businesses. Dan looked at financial due diligence pre-merger and how to manage and monitor some of those finances post-merger. I'm going to focus today on a number of the legal elements of post-merger integration. My talk is going to cover three main areas: the points of friction which commonly arise on a deal, how to mitigate risk, and legal tasks which need to be completed as part of post-merger integration, something that Dan definitely picked up on as some of those administrative tasks which are easily ignored when people try to get back to running their business. So starting with points of friction, my experience of completing buy and sell side deals involving consultants, there's three main points of friction which come up on many types of transactions. Other people may have completely different points of friction, but these are the ones that I commonly see. The first being IT, second, financial management, and third, getting the buy-in of employees and looking at making changes to employee terms. So starting with IT, whatever the size of the business, IT is now integral to how we all work, whether it's financial systems or CAD software. Post-merger, there are sometimes two conflicting business goals. The first is that the management of the combined business want to cross-sell services. So what they want to do is they want to get some value out of the transaction, not just an increase in turnover or profitability, but actual how can we work together? What are the synergies? How can we cross-sell those services to clients? But there may be something that conflicts with that, and IT can sometimes want to take a longer view to make sure that there's a full and proper integration of the two businesses' systems so that everything works effectively. Both goals are equally valid, but they must be properly planned. On day one of the acquisition, the parties should ensure that there's a limited impact on the acquired business's ability to continue operating. However, to build confidence in the deal rationale, there must then be short and long-term goals to fully integrate the systems. Failure to do so might actually hamper IT's ability to support the company's growth ambitions. Dan has already looked at merger accounting and having a 100-day plan. It's worth keeping in mind that differences in how work in progress is calculated, bad debts, etc., can be a cause of friction themselves, particularly between buyers and sellers. And we see this often where it impacts on an earn-out or payment of deferred consideration. Hopefully, these issues will all have been resolved prior to completion in the accounting documentation. Turning to getting buy-in from employees, well, it's quite natural to have a fear of change, and it's therefore important to have frank and open communication with any sellers that remain in the business and with the acquired business's employees. Where possible, it's better to let people know about change and its consequences sooner rather than later. A deal is far more likely to be successful if senior managers are involved and brought on side early in the acquisition process. Ideally, those links will have been established during the due diligence process, subject to any necessary issues on confidentiality. At this stage, it's probably worth having a look at an example of what might be classed as poor integration. Rather than looking at consulting businesses, I thought I'd take a look at my own industry and lawyers. We're as bad, if not worse, at undertaking our own acquisition sometimes. So I've picked a legal example. Law firms are professional services companies like consultants and have similar issues over things like valuation of work in progress, their contracts, etc. Last year, the Paribas Group went into administration. 2,500 unsecured creditors are apparently set to lose almost £50 million. And if you take a look at the administrator's report, it goes into a lot of detail about the integration that was and was not completed in relation to a number of acquisitions that they made. The administrator said there were significant volumes of mergers and acquisitions in the last decade by the Paribas Group, with many happening at the height of the market for quite large valuations. In particular, the administrator said that Paribas failed to fully integrate its business acquisitions, with separate case management and accounting systems in use across the business. Multiple systems created inefficiency and increased costs. While this might be a rather extreme case, it's a timely reminder of the risks involved in M&A by people who understood the M&A process and how you can have all these different diverse businesses, but if there isn't a plan for integration, it can cause problems at a later stage. So how do we go about mitigating some of this risk and giving the deal the best chance of success? Well, a deal structure is important as a means of minimizing risk. For example, one can ensure that a proportion of the consideration is subject to future performance, and I'd always recommend that within small teams within the buyer that they role play what would happen if a dispute arose in any of their business streams. A key factor is often whether the sellers remain in the business. If they do, this can be both a help or a hindrance to successful integration. How you deal with it is key. If the sellers are not going to remain in the business, then the buyer should consider what restrictions may be necessary to preclude the sellers from damaging or potentially damaging the newly acquired business. These restrictions could include, for example, non-competition covenants to prevent the seller from competing with the acquired business, non-solicitation of employees or clients, or various other type restrictions. So if a claim were to arise, have you thought about how it would be resolved? Are there dispute resolution procedures in the acquisition document? And where the sellers remain in the business, have a serious think before considering bringing a warranty claim against them. Seeking repayment of money could quite possibly destroy a key relationship and potentially some of the value that you've acquired. It's far better in my mind to consider alternatives to warranty indemnity claims, including, as I've mentioned before, sort of alternative dispute resolution procedures. My experience of mediation is that it's often successful in if even if you don't settle on the day, it's mediation process, and often it'll take you part of the way to settling a dispute. Consider having a contractual right to set off claims against future payments, so at least you're not asking the sellers to repay money they've already received. And also, I always advise on considering insurance. W&I insurance, also known as warranty indemnity insurance, is the generic name for insurance which provides cover for losses arising from a breach of warranty or in certain cases under an indemnity. The policy can be structured to indemnify either the warrantors, usually the sellers, or the buyer, depending on who is seeking the benefit of the policy. A standard insurance policy does not provide protection for specific indemnities for known matters which a buyer has identified in its own DD or in the disclosures which have been made by the sellers. Some of these can sometimes be insured either within the W&I policy itself or separately if the insurers have been provided with sufficient details. The major benefit really though of such a policy is that the parties can claim against a third party, the insurer, rather than each other. So during the due diligence and disclosure processes, the buyer is likely to have had access to a significant amount of information about the target. This might have been contained in email exchanges, in files of disclosure, or in a data room. A buyer should leverage this information as an integration tool. Due diligence and integration should not be regarded or conducted as distinct processes that don't overlap. You must ensure that you don't silo information between teams. The information you've collected can identify risks that might arise during the integration process. For example, if the buyer became aware during the DD process that the business routinely fails to obtain limits of liability in its appointments, put in place a plan post-merger to review all the business's standard contracts. An element of the 100-day plan that Dan mentioned might be a post-merger audit. This is a way of monitoring the success of an acquisition. Many businesses now do this as a matter of routine, both to review the acquisition process and to assess the integration of the new business so lessons can be learned and mistakes hopefully avoided. A post-merger audit may have many purposes, including to compare actual performance against projections, to assess the adequacy of the due diligence progress, and to establish and prepare warranty claims. As I just mentioned about assessing warranty claims, I think it's worth having a think about those prior to the end, obviously, of any warranty claim period. As part of the acquisition agreement, the buyer will have negotiated a number of warranties about the business and sought certain indemnities from the sellers. The warranties take the form of assurances or guarantees by the sellers. In its due diligence process, a buyer will attempt to establish as much as possible about the business, but inevitably it cannot find out everything. The warranties therefore provide a mechanism for price adjustment after completion, where a warranty is subsequently revealed to be untrue and the value of the business or assets is reduced as a result. So, following completion, it's important that the buyer ensures that the matters covered by the warranties are monitored so that all potential claims can be assessed. Finally, so you've successfully completed your deal and are on the way to integrating the business. However, as Dan mentioned, that's usually not the end of all the legal work. There's likely to be a number of administrative tasks which will also take up management time, and it's important that you factor that management time into your post-merger timetable. These can include things like filings to be made at Companies House, payment of stamp duty. Consider what are you planning to do with any superfluous subsidiary companies? Are they to be left, struck off, or be put into solvent liquidation? And if you are planning to make changes to employee terms, how and when are you going to make them? And are you permitted to do so under 2P? So really, that's my brief look at the legal aspects of post-merger integration. If there's one message I can get across today, then it's to spend time before the deal completes looking at the likely points of friction post-merger. It should be possible to resolve many of these in the acquisition documentation, saving everyone a lot of time and expense later. Thank you very much.
Thank you very much, James. We're going to hand back to Nelson to just round things up for us and close it all off. While he's handing over, can I just remind everybody that today's webinar attracts CPD points? And if you have any final questions, do let us have them. And I will, with that, hand over to Nelson. Thank you.
Thank you very much, Dwight. I think it's fair to say we've had the opportunity to go through this webinar series over 3 sessions. At the beginning, we were wondering what is the best way to sort of structure it, and we're very open-minded to suggestion on how we can improve this in future. We started by looking at growth strategy on the 18th of November. We dive into why you should look at growth. We also look at buying companies, what process you should go through. On the 9th of December, we went through selling your business. Again, we looked at it from the issue about strategic, financial, and legal. And today we've actually put if I can put it on, just the final part of the chapter, which is how do you deal with post-merger integration. One comment that's come out of this is recognizing the issue about the whole essence of buying or selling company. And again, I'm just going to repeat the 6 or 7 bullet points which I've talked about in the past. Is before you dive into this process of growth, have a clear internal capability analysis. Understand where there's a gap in your business and where you want to grow. Set out the very clear strategic objectives. Clearly focus on the needs. Want is very important, but focus on the needs. That's very important. Identification of targets, whether it's regional or country or sector or client. That is very important. Over the last 3 sessions we've had, the essence of proper due diligence has been echoed. And whilst we may probably think it's actually very expensive, but it's a good insurance policy. Having the right legal framework, having the right financial framework, having the right strategic direction is very important. And engaging the right professional people to help you in going through that process is extremely important. We've had a situation where people just come into it thinking they can close a deal without a proper due diligence process. Is very costly. Valuation of the enterprise is very important, whether you're selling or you're buying. And again, as was said earlier by Dan in his 100 days plan, or even said by my colleagues, James, as to how do you do post-merger integration audit is very critical. Do you close the deal? Do you achieve your objective? Deal negotiation is very important. Selling or buying. Transaction management is very critical. We talked about stakeholders engagement. Again, staff client expectation is very critical. You have to carry everybody along in the process. And today we've really focused on post-merger integration, which to me I think is converting the synergy, and actually whether it's saving or growing the market or growing the client base, that's very critical. So far as going forward, it's been a good opportunity for Dan, myself, and James to be able to share this sort of experience. And Dwight has been very kind in being the MC, guiding us through the process. And I'll say thank you to all my participants in this. More important for you, those who attended the very first one, about 85 of you, those who attended the second one, 65, and today I believe about 45. Thank you very much for your time. The particular presentation is available on the website, and will also be available on YouTube, so you can access it thereafter. And going forward, really, what we'll be looking at in the future is to see how we run this program in 2016, later part of the year. What would be extremely useful is to get some feedback from you, audience, as to where we can improve it, how best we can package it, and how best to make it forward. And on that note, thank you very much for joining us. Thanks a lot.